All right, everyone, welcome and thank you for joining us on episode 26 of Bullish. Remember, anything we discuss is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StangerFamilyOffice.com. I'm Sam Hardy, joined by Nick Stenger and producer We are Stenger Family Office. For the past 43 years, it has been our mission to deliver clarity and confidence to help secure your financial future. Two quick announcements before we get into it here. For our Houston families, if you haven't signed up yet for the Wealth Insights Forum on April 25th and 26th, it is quickly approaching the max capacity, so be sure to go on, sign up for that. You don't want to miss the reception dinner at Morton's on Friday the 25th, and then a half-day conference at the Four Seasons Houston on Saturday the 26th. Whole team's going to be down there, so would love to see you. And then second, we had a slight date change for Investor Day, pushed it back a week, but for our out-of-town folks, don't worry about it, all right? We're still going to have beautiful Chicago fall weather. That's going to be October 16th and 17th now, still at Gibson's, our biggest event of the year, so make sure you don't miss that. If you're not already subscribed, go ahead, do that. Like, share the show to get the clarity and the confidence out there. Also helps us continue to get phenomenal guests. Today, we've got another industry veteran joining us, Bob Carey of First Trust Portfolios. Bob, welcome to the show.
Good to be with you guys.
Bob, are you Irish?
I'm not.
Okay.
I'm not. I have an Irish name, which I got from my stepfather. I was adopted by my stepfather growing up, but I'm almost 100% Swedish ancestry.
Excellent.
Mostly Scandinavian, so I'm like a Viking.
All right. Yeah, I'm with you. Got Viking blood.
Yeah,
so let me just read a quick bio for you. You're the Chief Market Strategist at First Trust Portfolios, over 3 decades of experience as an equity and fixed income analyst. You bring clear and concise analysis, understanding of the markets, including current trends and opportunities of today and beyond. You've been a guest on Bloomberg, CNBC, quoted in publications like Wall Street Journal, Wall Street Reporter, Bloomberg News, and Registered Rep. Graduated from University of Illinois. We were just talking about this with a BS in physics, so wouldn't necessarily put you here. But a chartered financial analyst now and a member of the CFA Society of Chicago and the CFA Institute. I thought we could get started with the important stuff. Wanted to know if you guys are going to be buyers of CBOs. They are collateralized burrito obligations. I don't know if you saw the news with DoorDash and Klarna now doing a buy now, pay later on your food orders.
I saw that yesterday. I think that's a little scary, actually, that you have to finance your lunch. I suppose every time you use your credit card to buy something, in effect, you are financing whatever you're buying until you pay the balance. But the idea that you have to spread your payments around it tells you where we're at today. I think it's amazing how many. I just look at my own personal budget and whatnot, and thankfully I don't have a mortgage anymore. But I look at what I spend on Ubers and what I spend on DoorDash, and it's funny how things have changed. But thankfully I don't have to finance my lunch. So
yeah, I'm glad. We may have to have a conversation afterwards if you did, or if any of us did. But I think
and also sorry to jump in here, but Bob, you were like what, the 5th employee at First Trust?
Just about. Okay. I do go back to the beginning. I think I'm employee number 11 or something like that.
Wow.
which is crazy. But yeah, everything changed in 1991. I had just started working for Clayton Brown, the previous owner of First Trust, in the spring of 1991. And then by essentially the summer and into the fall, we extracted First Trust out of Clayton Brown and formed this new company that we have now. So, but it's just crazy. Just thinking about all the history we have now. It's, we've got 1,100 employees now, something like that.
Wow. Yeah. So First Trust goes back to the 90s, and you guys have started with unit investment trusts.
That's right.
Turn that into an ETF business. Now you guys do direct indexing. You do a variety of other things. Buffered ETFs has been a big grower.
Yeah.
But $240 billion in assets.
Yeah, I think right around 250, 260 here recently. It's just been crazy.
Wow.
To see the growth. But yeah, we started, as you mentioned, UITs were the only thing that we did back in the day, and we still have a dominant position in that marketplace, but we've used that success to springboard into these other things. It's, but you never know when you get into these new ventures. But we've definitely got to the point now where some of these new things we've been doing are now paying the bills. So.
Yeah. What's your take on where we're at today on, we just had a presidential election. We're going towards maybe some more volatility, more than people remember. Doesn't seem that bad compared to history if you look back.
It's true.
But if you look at the crystal ball, we usually save this question for the end. But if you had to look into the crystal ball today,
And I am looking
where are
crystal
we
ball.
headed maybe the next 6, 12 months?
Yeah, it's interesting. We've had a correction, a 10% correction, and normally the market goes down 10%, and some of the sentiment indicators I look for, like put buying, some of the surveys from like the American Association of Individual Investors and whatnot. Normally you'll see a spike in put buying, you'll see a spike in bearishness. We got to some pretty extreme readings here over the last couple of weeks, so it's interesting how we're down 10%. But a lot of investors are acting like we might be down 20% or more. And I think what it is, it's the Mag 7. There's been a lot of volatility around the Magnificent Seven stocks. And I think that's where most clients or most investors today, that's what they have. And it's almost like the rest of the market doesn't exist. And I think watching those stocks go down, in some cases 20, 30, 40%, some of them from their peaks, they really have surprised people. And everybody loves volatility when things are going up, and then we get downside volatility and everybody starts to hit the panic button. So, but I think ultimately, as the year progresses, it's going to get back to the Fed. What does the Fed do? How does the economy perform? And ultimately, it's about earnings. And if earnings estimates are correct, we should have a pretty decent recovery at some point this year. But obviously, the economy is what it is. We just don't know what some of these changes in policies could give us.
Did you watch the Fed meeting this week?
I watched Powell's, comments, and it was, his press conferences always. I never watch them. I listen. I don't. I try not to watch him, and it's interesting listening to him because obviously he's very educated. He's been a part of the scene for a very, very long time. I think he really wants to be transparent as much as possible, but I think he realizes that at the end of the day, as much information as the Fed has about what's going on, they don't know either what's going to happen. They're just, they're in a little bit better position than we are, but I'm not so sure sometimes that they really truly understand what's going on. They have to rely on the data just like everybody else. And as they get information, information's not hard to come by. You can gather a lot of information. There's a lot of economic numbers that come out every single day. And, we've got a feed that comes in with all the different economic numbers globally. And what we actually hear about is just a fraction of all the information that comes out every single day. So I think that ultimately he's in the end of his term. He's going to be there for a little more than a year, I think. I think it's next year that he's done. He doesn't have to worry about getting reappointed. I think he's being about as straightforward as you can be. But it's interesting. But yet he still hedges all the time, like a lot of these guys do when they become head of the Fed.
Yeah. Do you think I know they obviously kept rates where they were at. Is he in a tricky position here trying to figure out when to cut? Do we have to wait for something to really break, unemployment to spike, something like that?
I would think.
Or okay, because I know we've got like CPI is still hot, so they're still trying to get
Right,
CPI down to the 2% target rate,
right.
but the economy is also kind of strong. They don't want to reignite inflation like 70s and 80s, and so they're kind of in a tough boat here, right?
They really are. I think part of it's his own fault. When you come out and you say I want inflation at 2%, and you say that's your policy objective, and then you look at the history books and you're like, I mean, I'm 61 years old, and I've done the math on this, and close to 90% of my lifetime we've had inflation of more than 3%. Never mind 2%. So
Hmm.
it's just this idea. I think we kind of got used to inflation being low for as long as we did, where we did have inflation running at about 2%. And all of a sudden we go through the pandemic. And I think if Powell, the problem is Powell can't come out and say, well, we've kind of given up on this 2% number, maybe 3% is a more reasonable number, which is actually in line with long-term averages. I think his credibility would probably go up at that point. But I think that for the most part, he would like to do what Greenspan did. Greenspan ran the Fed for 19 years, and he generally kept short-term interest rates above the inflation rate those 19 years. And he would wait for something bad to happen, and then he would cut rates, and then they would raise rates again. And I think Powell has been more in that school, that he would rather keep rates a little bit high and give the Fed some room to maneuver if something happens. So, but it's a tough position to be in because you've got this dual mandate.
Well, in a 4.25 10 year is not that bad. I mean, a 4.25, if you trade the 10 year between 3.5, 4.5, I think mortgage spreads are kind of blown out here a little bit. But
Right.
if you're in that 3.5 to 4.5 range and you're growing the economy and things are good, like we went out to Hugo's last night as a team and had dinner, and it's packed. Like you
Right.
literally can't move.
Obviously, nobody got the memo about the recession, right?
Right.
I have the same. I was on a flight this week, and it was overbooked, and they were asking people to volunteer and not, take the next flight. And it's just, I mean, it's just everywhere you go. At least the economy that I see with my own eyes, for the most part, I just don't see a recession. And the job openings were really strong, and we'll see how it is. But I agree with you that these levels of interest rates are not high. They're certainly higher than what we were used to for a long time. And that's kind of the aberration, is those years after the financial crisis to hold rates at zero and to have inflation running at 2%. I would rather the Fed hold rates at 4 and give them some room to maneuver if something were to happen. And I think, ultimately you think about your clients and all of us. You work and you save your money, and for almost 15 years you did not earn enough interest to offset inflation. Even though inflation was low, your real earnings, your savings were actually losing purchasing power for a long time. I think this environment's better to have rates a little bit higher, and I think that it does. Maybe I would hope that better decisions are made about capital allocations and all that too.
Yeah, and we saw Bill Egan on from J.P. Morgan on CNBC the other day, and he said the same thing. He said after Powell's speech, you've got this trading range on the 10 year, and what's wrong? What's wrong with that? And I think all these people are out there hoping for these rate cuts to come in,
Right.
and it's like be careful what you hope for or wish for, because if we get significant rate cuts, it means something has gone wrong.
Right. Yeah, I think we will get better inflation numbers. I think as the year goes by, I think, I'm seeing prices of some things moderate. Used cars, the price of eggs down. All of a sudden, I go to the grocery store. Some of the things that I buy, I kind of use as my own CPI. It's like, those things are no
Yeah,
longer
boots on the ground
escalating.
work.
Yeah, I mean,
Yeah.
it's just I don't see the prices escalating like I did maybe a couple of years ago. So I do think that inflation will moderate a little bit from here, but I don't know if it's going to go back down to 2 without a recession. I think that would true. That's the only way we're going to get inflation to be at or below 2%, is we need almost deflation, not just disinflation.
Are you a Costco member?
I used to be. I tend to join Costco every time I'm in the market to buy a car. I don't know. It's like, I'll join for a couple of years, and then when my kids were younger, it made sense to be a member, but I just, it's just my wife and I at this point. So
So not to brag, but I'm a Costco member,
sure.
and I was just there, and I'm trying to like see what's the cheapest I can walk out of there for. So far, I'm still like over 200.
Absolutely.
And
What a business that is. I mean, it's just an incredible business. One of the first stocks that I analyzed in my career was Kmart. Okay, so Kmart, there was a reason for that. Where I was working, we had clients who worked at Kmart. They were in upper management and whatnot. Well, this is 1986. Okay, I'm just starting my career as a financial analyst, and I'm trying to understand all this stuff. And Kmart's obviously the biggest retailer in the country, basically, especially on the discount side. But they had competition from Walmart. By the mid '80s, anywhere you went around the country, pretty much, especially here in the middle part of the country, if there was a Kmart, by that time there was a Walmart right down the street or next door even, and you could see. I mean, Kmart was selling at maybe 5 or 6, 7, 8 times earnings. It was very, very low, no growth, and Walmart was growing at 25, 30% a year. They're opening up stores everywhere. High multiple, investor expectations obviously very, very high. And we looked at the two companies, and they had the same profit margins. You're like, what's going on here? Well, Walmart turned over the inventory in their stores every 2 months. It took 6 months for Kmart to sell everything in the store. So that, the reality is, I mean, you take, it's classic asset turnover and you multiply it by margins. Walmart was a 13%, 14% return business. Kmart was a 5% return business, and they're no longer with us. I mean, and now we've got Costco turning over their inventory in less than a month,
Wow.
and with even better margins actually than what those companies were doing 40 years ago. So it is amazing how good some of these companies are at doing what they do. And retailing is a pretty simple business. It's about getting your inventory on the shelf or in the warehouse and getting it sold and just doing it all over again, and hopefully have enough margin that you can continue on. And margins are low in retailing, so the name of the game is just speeding up, the turnover of your inventory. So Amazon and all these companies are just doing amazing things with managing their inventory.
Well, one of the companies on the shelf behind you there is Walgreens, who we used to have a lot of employees from Walgreens as clients, still have some. And Walgreens in the 80s and 90s and even the early part of the 2000s was the darling of Wall Street. I
Yep,
mean, it was like a
exactly.
20% a year stock,
Right.
like Nvidia would be today.
Right.
And now look where they're at.
That's right.
And it's like how you look at Walgreens and you look at their decision making, you're like, how did you guys miss this?
Right. Exactly.
I never go to Walgreens.com, and I think, the other week I told the story on the show last year, but I was literally in Walgreens, couldn't find what I needed. I pull up Amazon on my phone and it was shipped to me the next day.
Right.
It's like, how do you miss that wave?
Exactly. Yeah, you have the inventory, you've got the relationships with all these vendors. Why wouldn't you leverage that? And the problem is, it's hard to do more than one thing well. And I think companies, generally speaking, successful companies are very, very focused on one thing. And the problem with Walgreens is they focused on their stores in mostly densely populated areas, and they did an amazing job at that. And then they get involved with Boots, and they lost their focus. And companies fade. Every great company eventually meets a point where they just simply can't continue on and do what they do. And I think investors thought that a Walgreens was always going to be a great company. And it just goes to show you, not every company can stay that great for a long time.
Not to name too many names, but of the S&P 500 today, are there any like a Walgreens that you look at and you're kind of concerned about?
Great question. It's funny. I think one of the things that we always do with our analysis when we look at individual companies, maybe a sector, but mostly individual companies, one of the things that we can do is we can essentially map the future. So we can take the current financial performance of any company and we can take it from there, and we can do all kinds of scenarios. There's some of the scenarios are very positive, some of them are very negative. And every scenario, we calculate a valuation. And obviously, the positive scenarios give us high valuation. So we go back and forth. We do what we call iteration. That's a fancy word for guessing. So we're guess high, we guess low, and eventually we arrive at a valuation that's the same as the stock price. And when you do that, you can really essentially see what the market thinks will happen in the future. And one of the things that I think is kind of interesting is there are a lot of companies that are I would call them non-cyclical consumer stocks. Companies that are very, very stable, been around a long time. And I see a lot of these companies right now, for some reason, their expected returns are actually higher than their historical and current rates of return. Um, these are some pretty well-known names, very, very stable, non-cyclical consumer stocks. And it's amazing how investors are willing to pay up for those kind of companies. It's sort of like buying treasuries at, 1% or something. It's like, well, at least I'm not going to buy something that's going to fail. Well, that's true, but I think there's a pretty high price for that part of the market right now. I think,
Companies like Pepsi, for example, or things like that.
yeah,
Okay.
companies that they're going to be around. At least you think they're going to be around and whatnot. But they've been successful. But the expectation, these are good businesses, but you're paying up for returns down the road that maybe they get better and their returns go up, but at the same time, there's no guarantee.
What about defense stocks here? Obviously, a lot of talk about Doge and cutting budgets. And you saw Accenture, the news this morning, where they're going to lose a ton of their contracts. I think the stock was down 7% in the pre-market.
Right.
And is that going to have a ripple effect? I know defense has kind of priced this in already, and Lockheed was down a bunch. Northrop Grumman was down a bunch. Do you see that continuing, or do you see the bleeding stopping and then the defense stocks come back here?
I think eventually those companies are, we need them. I mean, and we can't let those companies fail. And we obviously from a defense perspective, national security perspective, we have to have them. I think there's no doubt the days of budgets going up 30-40% a year in the defense budget, like we saw for a couple of years. I don't think that's, sustainable. And right now, I think that most of those companies have got a pretty good fade baked into the share price, which should give them some upside. Maybe the biggest company in that space we just don't know what they're gonna look like in 5 years is Boeing. Boeing is obviously the defense side of the business pretty stable. I mean, they're very good at what they do, but on the commercial side, they are really struggling to get things going. And what's funny is passenger traffic is up. We're flying like at levels that we saw pre-pandemic, and we're seeing the airlines begin to put orders in, but it really hasn't translated into better earnings and cash flow for that company. They're still having trouble with a lot of operational issues right now.
It's interesting. I fly a decent amount like you do for work. I don't fly maybe as much as you, so you see this more. But I've seen the Boeing new planes. I've seen the new Airbus planes.
Yeah.
And I really feel that Boeing has lost the innovation battle with Airbus on this. And you look at these new Airbus jets, and they're just engineered better. I was sitting next to somebody, and he couldn't get his backrest to go back, on a brand new Boeing jet. And you're like, how do you guys miss this stuff?
Right.
You get in an Airbus and it looks great. It's clean. It's just, I think they're better, so I think they've lost a lot of that innovation that they used to have.
That's an interesting observation. I rarely notice when I'm flying, when I'm on a plane. I'm like, I just want the plane to get there in one piece.
Yeah. You don't want to
Which
end
has
up
also been a concern the last few years if we're looking at Boeing. But
I was actually in D.C. A couple of years ago, and it was the day that Boeing's 787 MAX went down. I believe it was somewhere in the Middle East or maybe Africa. And I just happened to be in a law office in D.C. that was the largest patent attorney IP law office in D.C., and Airbus was their clients. And watching these partners of this law firm, obviously a tragedy happens, and they're concealing their smiles, but not very well. Like, oh, thank God it wasn't Boeing that, or it wasn't Airbus that was involved in this. And I really do think Airbus has taken advantage of that publicity the last couple of years. And that's what you mentioned about the quality. That's probably true.
Yeah, I mean it's unfortunate, but we'll even joke like when we have to book travel for work, we'll say, "Oh man, did you get an Airbus?" Like thank goodness we got an Airbus.
And then you get a sinking feeling when you check like right before, and it says plane change.
I'm going to Italy on vacation in a couple of weeks, and I'm not sure. I'll have to look up what plane that is. Well,
yeah,
but.
Well, I think a lot of these, it's an interesting point too with COVID, because I think what happened during COVID is a lot of these companies sent their people home like they had to.
Yep.
And then some of them never brought them back. And I think Nike had this problem, especially where they're saying, hey, I think Westbury said this, or maybe you said this, where we can manage a great company remotely, but it's hard to grow it. And
That's
it's hard
true.
to innovate.
Absolutely.
And I think Nike's CEO came out and said, wait a second, like we have no innovation anymore. Stock's down, what, 50-60% from the all-time high.
That's right.
How many other companies are there out there like that still are behind the ball now because of COVID?
That's right. And I think, the tech sector especially has really, I mean, you think about young entrepreneurial engineering software kinds of people. There was a day, you go back 30, 40 years ago, you graduate from engineering school, and that was the goal, was to maybe go work for Boeing, or Motorola was a big example here in Chicago. And it was just I heard that all the time when I was in school back in the 80s. A lot of my friends went to work for these kinds of companies. And now it's I want to go work for Tesla, or I want to go work for NVIDIA or whatever. I just think there's only so much talent that's able to move the ball from an entrepreneurial, from a growth perspective. And these big mature companies that are, once the perception is, oh, that's a broken company, it's hard to get that perception turned around. And you watch what's happened to Intel, for example. Intel's another company that, boy, that was, I remember interviewing with Intel back in 1985, and they were the recruiter, this guy from California, is like, wow, we're going to, one of these days, we're going to be $1 billion company. And I'm like, oh boy, at the time, it's like, wow, can you believe they're going to be $1 billion company? Well, now they do $1 billion in business every couple of days. But, there was a time when they were growing at 30% a year, 20% a year, 15% a year. And all of a sudden they've got a lot of competition now. So once people start to see the company falter, a lot of compensation on the stock side, stock falls, that people are just gone. There's nothing to hold them there if they see that upside potential disappear.
So not to upset too many of our people on YouTube, so please don't leave a mean. Do whatever you want, but we're not trying to purposely upset you in the comments here with this one. But Doge, what are your thoughts?
Well, we got to shrink the government. Just my opinion. I think we can't have $2 trillion deficits into perpetuity. At some point, we need to shrink the size of government. And the problem is every time we try to do it, it's a very unpopular thing. It just generates, and you think about it, you've got a lot of people that start to get worried. And, I think I worked for the government for a little while when I started my career in the Department of Energy. And, a lot of people go to work for the government and they never leave. And they really don't, normally you go to work in the private sector, you change jobs throughout your career and you just, and I think a lot of people go to work for the government and they perceive it as being, well, I'm safe. I'll never get laid off. I'll never get fired. And all of a sudden we're laying people off. And that's millions of people think that they're safe. And all of a sudden they start to realize, oh, I might not be as safe as I once thought. And I think that's where all this tension has come from.
I don't understand though the people where they're like upset with Doge, the Department of Government Efficiency. Like you're upset that the government is going to be more efficient, right?
Right.
And Bill Clinton tried to do this, right? And even though there was a video that just came out on Twitter of Obama talking, it's not AI, it's a real video
Right.
of Obama and Biden talking about how they want to make the government more efficient. And
Right.
they were going to put Joe Biden in charge of it.
Right.
And then those people who are upset with all that, at the same time, they go and complain when they're at the DMV. And it's like, I just
right.
went to the DMV. I had to get my license renewed.
Oh.
And I'm thinking to myself, I could have done this in 2 seconds online,
Right.
but and you go in there and there's one line to hand them your paper for them to figure out where you need to go. There's another line so you can go talk to somebody so they can stamp something. There's another line so they can take your picture. Then there's another line where they actually print it out and give you the piece of paper you need, the temp ID. And then you have to wait 3 weeks and get your ID in the mail. And you're like, if this was a private company, you guys would be out of business.
Exactly right. Yeah, government efficiency is almost an oxymoron. It really is. It's hard to imagine anything less frustrating sometimes than dealing with the government. And sometimes you're surprised things aren't so bad. So it's not necessarily all bad, but I think for the most part, I think we all understand the government it's not a private sector enterprise. Its whole objective is to do things on its own pace, and the bureaucracy has its own speed, and we just have to deal with it. But I think that it's fine when you're not running deficits like we've been running, but all of a sudden you have these deficits like we have, and I think a lot of people are starting to get concerned about these deficits, and nobody wants to see spending come down. We've been growing the government pretty much every single year of my lifetime, and especially the last 25 years. If you look at GDP and you look at government spending compared to where we were 25 years ago, this century has really been a series of events that have all led to higher levels of government spending. And I just think that it makes sense from a financial perspective. We have to bend the curve down a little bit, and we can finance a $2 trillion deficit. We have enough wealth to do that, hands down. There's not really an issue with that. But is that really what we want to do? And let me share a little story with you. I gave a presentation about 10 years ago. I'm actually closer to 15 years ago now. And I met this guy, gave my speech. I finished speaking. I start talking to people. This guy pulls me aside and he's like, I really like your presentation, but you didn't talk about the deficit. And I'm like, okay, let's talk about it. What are your thoughts? And he goes, it's going to take the country down that we have these deficits. And I'm like, okay. I'm not so sure. I mean, it's not good that we have these deficits, but I don't think that it's, so far, every time the Treasury comes to market, auctions off securities to finance a deficit. It doesn't seem to be a problem. We have the assets and whatnot. And the guy's like, I'm not sure what you mean by that, but I'm just like, he's really worried. So I said to him, I said, all right, I assume you've had this conversation with your financial advisor. And he goes, yeah, we talk about it all the time. And I'm like, how is this affecting your asset allocation? I said, that's really the end game is what, if you're this worried about the deficit and you have this concern, is it really an issue for you where it affects your portfolio? And he goes, absolutely. He goes, look, I've got plenty of money and I don't need to earn much interest at all. I mean, it's just, this is back when treasuries were a lot lower than they are today. He goes, I earn enough interest and if I'm going to be fine, my kids are going to be fine. He goes, heck, my grandkids are going to be fine. And so I found out later this guy was actually the wealthiest person in the room, probably hands down. He had owned a company that made, I think, irrigation equipment for the agriculture sector, and he'd sold this company to another company for hundreds of millions of dollars. So he's wealthy beyond belief. But he tells me that pretty much all of his portfolio is in treasuries. And I point out to him, I said, it's interesting to me that your biggest worry in life is the deficit. And here you are with your wealth financing the deficit. He goes, I'm not financing the deficit. I'm buying treasuries. I'm like, oh my God. So, and that's the problem when you start thinking about these things. I mean, at the end of the day, this guy, the one thing that he is complaining about the most in life, the treasury and the deficits that we have, and yet he's scared to death by that. And yet his reaction is to lend the government at these very, very low interest rates. And I'm like, he's made all this money in the private sector, obviously an incredibly successful business owner. He knew how to allocate capital. He knew how to run a business, create shareholder value, create wealth for himself and his family. And here he is in the later stages of his life, and he's just lending it to the government and then complaining about the government spending all this money. And I'm like, wow, it's really kind of funny how backwards sometimes things are. And so I think that those high levels of deficits have a way of actually scaring people sometimes. And I think the government sometimes benefits from that. You think about how low rates were during the pandemic. We had a 0.5% yield on the 10-year treasury, 0.5%. I mean, that's just, the 30-year, I think, got to 1% briefly. I mean, people were scared out of their mind. Well, what's the government doing at the time? Well, they're sending checks out like crazy and spending money and increasing the size of government during that time. So that's my concern is that these deficits, if we don't get them under control, we're going to continue to have allocation issues for a lot of people.
Well, it's amazing to me too, especially you watch this case study of Europe going on, and and the EU has been around for a long time now.
That's right.
So you can watch how, like, what not to do, basically.
I tend to agree. Yep.
And they have a population crisis on their hands. They have an immigration crisis. They're losing their culture. Everybody talks about it, and then every time anybody makes any money, like an energy company like ExxonMobil or somebody comes in and makes a profit, they fine them, into oblivion.
That's right.
And then all their companies leave. And then their answer to that is to pass more stimulus.
That's right.
And you're like, you could just be friendlier to business. You could deregulate a little bit, and you could cut taxes.
That's right.
And I have people here, our clients who are originally from Europe, a lot of them, who would never go back and want to die in Europe, because if you die in Europe, in most of these countries, you have a 50-60% wealth tax at the end of your life.
That's right.
So you look at that and you say, why in the world? You look at Europe and you look at the mess they've created. You say, why would you ever go down that road? Yep. But it looks like all these other economies are trying to do some of the same things.
Yeah, it's interesting how, the Europeans, they get together, they create this common currency. They did knock down trade barriers between member nations, which is a good thing. But at the same time, they created a lot of bureaucracy that sits on top of all these countries, in addition to their own countries' bureaucracy. And we see it when we look at companies. There was a time when I could have taken a company in the same industry. I could have looked at a company in Japan or Germany or the U.S., Canada. It didn't matter. And if you didn't tell me what the company was, and I looked at their financial performance, there really wasn't much difference between U.S. companies and European companies. They're all, they all kind of look the same from a shareholder value perspective. It was obvious the economics were the same for all these companies, but today, the average company in the U.S. is without question superior to the average company in Europe. Just to give you some numbers, there are a lot of measures of return on capital, return on investment, but the one that I tend to use, we've seen companies in the United States go from generating 6% returns on capital historically. If companies make their estimates this year in the S&P 500, returns on capital, returns on investment are now 10%. And at the same time, Europe is still generating the same 5.5 to 6% returns that they've always generated with fewer levels of lower levels of growth. So that's really the main reason why we have valuations that we have today, I think, compared to Europe. A lot of people look at Europe and they're like, wow, it's 15 times earnings. We're closer to 20, 21 times earnings. The value investor in me is like, well, I should just be buying European stocks. And I'm like, you've got to take into consideration growth rates and what companies are able to do with their businesses. And U.S. companies have just, there's no equivalent to, we just don't see companies in Europe, especially that can do what our companies do.
Well, and that's the whole thing. I mean, I think Jamie Dimon had a quote like this where he said, "Nothing pays for anything like a growth strategy," which just really stuck with me because it's such a basic saying. But that's basically what you're saying too.
That's right.
It's like, yeah, valuations are 15 times earnings, but you haven't grown your earnings for 10 years.
That's right.
And we talk about this internally about value and how, yes, you can make money on value. Obviously, equal weight value's doing well this year. It just seems like it's always a trade, though. Do you agree with that, or do you think there is this longer lasting rotation to value that we're going to continue to see?
I do think that value, I think a lot, we look at portfolios all the time, and I do see a lot of investors that have just given up completely on the value side of the marketplace. And I think from an allocation perspective, you should have some value stocks. I I think the name of the game is looking at valuations, but you've got to take into consideration growth rates. So I think the more reasonable strategy is growth at a reasonable price and trying to figure out what's a reasonable price. I just think that most companies that are on the value side of the marketplace, a lot of those companies, they tend to have lower returns on capital. They tend to grow slower. The valuations are cheaper for a reason. And whereas growth companies, obviously, the key is just making sure you don't get carried away on the growth side and you just don't overpay. And that's I would rather pay up for a good company and then watch it, make sure that it doesn't fade and make sure that it continues to create shareholder value. I really don't care how it's classified, whether it's growth or value. I think that for the most part, markets are pretty efficient in terms of figuring out, well, this is a good company and that's not a good company. We have had moments, though, over the years where the market gets carried away. And I think back to the pandemic, boy, there were a lot of these work from home companies that just got insanely valued. I mean, just really, really highly priced. And you're like looking at this pandemic, I'm like, are we going to have a pandemic every year? I mean, it's like at some point we are going to get back to normal, you would think. But it's funny how conditions that we're in right now, oftentimes they don't persist. And the perception is, well, what we're going through right now, we're always going to be going through it.
The new normal.
So we tend to extrapolate what's happening right now and think that this is how things are going to be forever. And it never is. It's just so investors, like it gets back to that whole thing of fading. At some point, there's going to be a fade, and you got to be sensitive to that.
Well, and we had the 10% correction, but you look at the underlying fundamentals, it's not like you've really seen a drop off in expected earnings moving forward or anything like that. So, would you agree with that?
Yes, we watch earnings estimates like a hawk, and what I've noticed in the last 2 or 3 weeks as we've gone through all this volatility is that estimates especially for the S&P 500, they haven't changed at all. We have seen estimates come down a little bit for mid caps and small caps, but that was going on back in January too. So I think investors or the analysts who cover all these companies, I think have been taking estimates down for the smaller companies as opposed to bigger companies at this point. So, but then you think about where the 10-year was at 480 for a little while. Now it's closer to 420. That's a 60 basis point drop in interest rates. That actually is bullish. I mean, I think if you believe these earnings numbers, these earnings estimates. I think the market actually is better priced now than it was a few weeks ago, substantially better, because of the combination of estimates holding up, to your point, with lower interest rates. That's usually every model I have that actually raises valuations. So
Yeah, it's also amazing to watch these Wall Street strategists where, it's tough, right? It's a tough job to forecast, and for legal reasons, we won't mention any names here specifically, but, you see some of these prominent analysts at the most prominent banks, and for 5 years they were bearish, and they said their base case was market goes down 10-12%, right?
Right.
And then this year they finally turn it around. They raised their target on the S&P to like 6,700, and now the S&P's down,
Right.
and you're like, how are you wrong for 5 years and now a 6 year? And like, how are you still employed? That's what we're trying to figure out.
Yeah, the key to predicting is to predict often. That's what Louis Verkeyser used to say that back in the 80s, and there is some truth in that. But it's a hard business to be on top of things long term. It just short term, 1 year is like, who knows? A lot of things can happen in a year. I think the key is longer term and just focusing on the longer term and just having the humility to go. I don't know what's going to happen short term. I just don't know.
Yeah, we saw this great quote the other day. I don't know who said it, but it was be careful betting on the end of the world, because if you're wrong, you're going to lose a ton of money. But if you're right, it won't matter.
That's true.
So
that's very, very true.
And we've called the show Bullish. So I guess, Bob, as a last closing question today, we've got the Dow 500,000 hat here.
I love that hat. I love that hat.
Am
I allowed to keep this hat?
That's for you.
That's for you.
Okay.
That's our present to you.
I like it.
Do you believe that long-term story, whether it takes, I think we did the math, 35, 40 years, whatever it is, are you still in that camp of Dow 500 and that sentiment long-term? Are you still bullish?
I hope I'm around to see that happen long enough. Yeah, I do think so. I think to me, it's the combination of a couple things. Every single year there's more money in circulation. That's by its very nature means that the prices of things will go up in general. And I think you couple that increase in the money supply with more products, more services. That's the fuel for stock prices going higher over the long term. It doesn't mean it's going to happen every year, but I do think longer term, that's where we're at. I think based upon these levels that we're at right now, I do think for the next 5 to 10 years, we're not going to see the kind of returns that we've seen the last 10 years. I think it's good to lower expectations, maybe closer to 5 to 8% probably for the next decade or so, for the averages. But I think that over time, there's no doubt. I mean, there's a lot of great companies out there that you're going to want to own.
Awesome. Thanks so much, Bob. Sam, you want to take us out?
Yeah. Thank you, Bob. Thanks, Nick. And thanks to all of you for listening in episode 26. Please remember, like, subscribe, share the show so we can continue to get phenomenal people like Bob with us. If you have any questions on working with Stenger Family Office, give us a call, 630-912-8431.